All right. So, welcome everyone to my last class of the day, or the number 3 for the day. We're going to be talking about the employee retention credits. Before we get started, I just want to throw this little disclaimer out there that I base this on what's available. It can always change at any time, but I try to make my best bet to figure out what's going on. So, um, stuff to get started. Please keep your mic on mute because we are recording this. I don't want any kind of crazy sounds in the middle of the presentation. If you have questions, use the chat button at the bottom to ask questions. Heather is here online and she's going to gather questions. At the end, we'll go over them and I'll do my best to answer them. Again, it's going to be recorded and probably it'll be available this afternoon. We've been finishing these up pretty quick and then just go ahead and publish them and send them out. So probably by the end of the day, you'll get a email with slides from this along with a recorded link and whatever else Heather wants to send you. So I'm not going to go over this because most of you have been through the bill that was, through one of the classes. For you, the ones who didn't, this is just going to kind of give you a breakdown of some of the stuff that is included as part of the program. I will tell you, if you're available, if you're interested in doing the PPP, I just got an email right before class that the SBA is opening up application as of Monday, January the 11th. So you are able to submit application as of that date. The problem is we don't know what banks or who's taking what as of 11th or when they're going to take them. The only bank locally I know that has publicized they're going to do something is the Bank of Fincastle. Other banks, I'm sure, will come available. Some online places will probably come available, but the SBA will be accepting them as of Monday, even though they haven't even published an actual application yet. So I'll assume we're going to get that sometime soon. All right, so today we're going to talk about the employee retention tax credits, commonly known as ERC. This is a pretty hidden thing because when it first came out, it came out in the CARES Act the same time as the PPP program, and everybody pretty much ignored it because if you were involved with taking PPP funds, you were not allowed to use the employee retention credits. So everybody pretty much just ignored this particular program. In fact, I don't know of a single client that took advantage of it. Well, with the new rule, with the new law that came out with the COVID Relief Act, even if you're taking a PPP loan, you can still take advantage of the employee retention credits. Even better than that, you can go back and claim them from 2020. So you can do it 2021 and you can also do it for 2020. So if you took a PPP loan in 2020 and you qualify based on the requirements, you can go back and apply for that and get money back. So anyway, it's pretty cool. So basically what the ERC is, it provides a tax credit for any business that experiences one of the following. So what we're going to be talking about is strictly businesses with 100 employees, which I assume that everybody here has less than 100 employees. If you have more than 100 employees, it has different procedures, but you have to go talk to somebody else then. But basically, one of the two has to happen in order to qualify. One is your business was fully or partially suspended in 2020 due to orders from an appropriate governmental authority limiting commerce, travel, or group meetings due to COVID-19. This means that the U.S. government, the governor, whoever shut down your business or partially shut down your business. Could have been a restaurant that was shut down. It could have been a restaurant that was shut down to inside business. Those are all partially suspended or fully suspended or partially suspended. All right, if that did not apply to you, you could also fall in the category that you had a 50% decline in revenue for any quarter in 2020 versus the same quarter in 2019. So if in the second quarter of 2020, your sales were 45% of what they were in the second quarter of 2019, you would qualify for this program. It has to be for the entire quarter. The top part, the first one does not. It could just be a week or 2 weeks long or whatever. The second one has to be for a quarter. Okay. The nice thing is for 2021, the sales drop only has to be 80%, not 50%. So you may also qualify for 2021 using a higher percentage of loss. This is available for a for-profit or a nonprofit. It is, as I mentioned, is not available for the self-employed unless you have employees. Okay. Again, the biggest thing is even available if you had PPP funds, it's still available to you. So what is considered a full or partial shutdown? So a business is forced to shut down or reduce operation by federal, state, or local regulation, then this counts. And I already mentioned that restaurants that can only do curbside service. I will say that it particularly says essential businesses that did not shut down, even if reduced, most likely would not meet the criteria for that unless they drop below the 50% capacity, or a portion of their business is not considered essential and that part of the business was forced to shut down. So how is the 50% decline determined? It's pretty straightforward. It's based on the gross revenue for a quarter compared to the same quarter 2019. Basically, it means that first quarter total gross sales in 2019 versus total gross sales in the first quarter of 2020. You're not going to take it in the first quarter anyway because it didn't start till March 12th. But if you look at the second quarter, did you have gross sales that were 50% of what they were in 2019, then you would qualify. Once you qualify for the program, that program will continue until you have a quarterly revenue that has reached 80%. So in other words, 50% is your buy-in, and then the 80% is when you get kicked back out. So if you just hit one quarter that's 49%, and then the next quarter you drop back up to 75%, you can continue to take that credit until it goes past 80%. So, so the changes in 2021 is that it's going to be 80%, not 50%. So if your business anytime in 2021 drops below 80% of what they were in 2019, then you can qualify for this program. In other words, if you did $10,000 in 2019 for the first quarter, and your first quarter of 2021 was $7,500, then you would immediately qualify for that program. Actually, if you did $7,999.95, you would qualify for it. Okay. And then you would continue in that until 80%. But for basically, if you qualify in the first quarter, you're automatically qualified in the second quarter. And this only runs till June 30th, so it's only the first 2 quarters of the year. So if you qualify in the first quarter, you're going to qualify for the rest of the program. Unless they extend it, which they could. So what is the amount of the credit? This is the cool thing. So it's equal to 50% of the qualified wages paid to an eligible employee during the covered period. In other words, you're going to get paid back 50% of any wages that you paid to employees during this period of time. And since you have less than 100 employees, because that was the guideline between how it worked, you could be paying your employees to work and still get the credit. So they could be physically at work, doing work, earning income, and you can still take the credit. That's the difference. If you had more than 100, they'd have to actually be laid off in order and being paid in order to get the credit. But for everybody here, it's going to be, even if they're working, you can still claim the credit. So the way it works is a maximum amount of qualified wages that can claim credit for is $10,000 or a maximum $5,000 credit since it's a 50%. So for the first $10,000 that an employee works and gets paid qualified wages, you can get $5,000 per employee. If they work 8,000, if they get $8,000, you'll get 4,000. If they work and get $20,000, you still can't get much any more than 5,000. But it's for the first 10,000. It has to be qualified wages during a qualified period. But it can cross over to multiple periods. In other words, if it takes 2 quarters for an employee to get $10,000 and it's still a qualified quarter, then that's okay. You can continue to get the quarter. All right, covered period. Qualified wages include healthcare insurance paid by employer and premiums paid by the employee with any pre-tax dollars. Okay, so it includes both. So the 2020 credit was from March 13th to December 31st, 2020. And that's was, again, if you had a PPP last year, or if you didn't, you can still go back and claim this credit. PPP doesn't have anything to do with claiming the credit. It's just a matter of if you had it, you can claim it now. But if you didn't have it, you can still claim it. So you need to look at your records to see if this applies to you in any credit last year. So new for 2021 is that this credit is now equal to 70% of qualified wages. So for every $10,000, you actually get $7,000 reimbursed, not $10,000. And even bigger than that, it's based on a per quarter. So you can get $7,000 if it's $10,000 in the qualified wages in the first quarter, and you qualify in the second quarter, you can actually get $14,000 for $20,000 worth of income that's paid or wages paid to an employee. I'll give you some examples here in a minute, but that's a pretty big deal. Again, even if they're working, they can still claim the credit. Again, it's including healthcare insurance paid by employer and employee pre-tax dollars. So the 2021 program runs from January 1st to June 30th. All right, so I just ran through some questions here that may help explain some stuff. Are employees required to withhold employment taxes? Certainly, because these are payments. You're still going to withhold Social Security, Medicare. It's still going to be taxable to the employee, et cetera. Are self-employed individual eligible? No, unless you have employees. If you have employees, then your credit can be for your employees. If a business decides to close or reduce its hours of operation, even though it was not required to, can they obtain the credit? No, you cannot, because it has to be government issued shutdown. Of course, you could qualify if you reduced your hours and you drop below the 50% or the 80% for 2021. If an essential business is shut down because the supply chain is shut down, and this happened to a lot of businesses, can they claim the credit? And it's pretty much a maybe, so it's kind of like you have to look at each circumstance to see how it affected your business. One thing the IRS specifically stated is restrictions of customers to stay home. In other words, if the government said you shouldn't go out to do things, restrictions to restrict customers is not a qualified as shutdown or partial shutdown. It has to be something that directly affects your business. If a business is required to shut down or partial suspension, but then opens back up, how does one claim a credit? So the way it works, if you drop below the 50%, you can claim that credit during the whole period, that whole quarter that you're below 50%, and every period until you reach 80%, including the period that you reach 80%. That's under that particular reason. If you're forced to close down, but then you're able to open back up, it's only going to cover the period that you're physically have to close down or partially suspend. It doesn't include any additional periods besides that. So what are gross receipts? Pretty much the same thing as reported on your federal tax return. So whatever you report on federal tax return is what you use. So what if a business did not operate for all of 2019? So this is pretty complicated answer, even though it makes sense. So you use a full first period of 2009 as your baseline. So in other words, if you open on April 1st, then you're going to use the second quarter of 2019 as your base period for the first and second quarter of 2020. Then you would use third quarter for third quarter and fourth quarter for fourth quarter. So that's kind of the way that works if you're not open for all of 2019. So if you purchased a business in 2020, can you take the ERC? If you acquired a business either through stock, asset, or other form of acquisition, you can take the credit and based on the 2019 numbers of the acquired company, providing you have a purchase agreement from the company, whether it's a stock purchase agreement, asset purchase agreement, that you're basically having an agreement that says you're taking over the company. What are the gross receipts for tax exempt organization? That's going to basically pretty straightforward. Includes gross receipts from all the operations, investment income, contribution, grants, dividends, rents, unrelated business income, et cetera, et cetera. So that's what your comparison is. All right, so number 10 is a biggie for some people. It may not matter to some of you, but it's one that kind of jumps out. Are wages paid to related individuals of the employer considered qualified wages? No. So if you're paying wages to any child, grandchild, brother, sister, stepdad, sister, father, mother, stepfather, blah, 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 those wages do not qualify for wages for the credit. Okay. So it may or may not affect anybody here, but certainly affects some people. And it's probably something most people don't know about. So how do you claim this credit? So now you've got this credit, you know you're going to have a credit. So let's just say it's 2021 now, and you go back and look and say, yeah, I qualify for this for the second and third quarter of 2020. So what you have to do is you go back and file a 941X, which is the adjusted employer's quarterly federal tax return or claim for refunds, basically an amended 941. And you can file that where you can claim the refund for that by filling out the employee retention credits in there. And you in turn would get a refund for any amount that you've already paid. All right, so if you're claiming for 2021, the way you do it is if you know that you're going to qualify for a certain amount of credit, you can withhold paying your 941 deposits up to the amount of the credits you know you're going to get. So if you're making 941 deposits for your Social Security, Medicare, and withholding taxes, you can withhold that amount up to the amount that you think you're going to be getting back as a credit, and then you reconcile it when you do your 941s. Okay, so it's pretty cool. You don't have to wait to get your money. You can actually use your money during the actual quarter that you've earned the actual credit. Your other option is that you can actually file an IRS form 7200. This is an advance payment of employer credits due to COVID-19. If you don't think you're going to have enough deposits from your Social Security, Medicare, and withholding to pay you back for the credits that you're going to incur, you can actually ask for money from the IRS in an advance payment. And they'll actually send you money and say, okay, use this as your credit. Okay. So that's a pretty cool thing. The only limitation is the form. The form can be faxed. The only limitation has to be at least $25. And I don't think anybody's going to spend their time filling out a form for less than $25 or even for $25. But if you think that you're going to receive $10,000 in credits and you know your withholding is only going to be $500 or a couple of thousand, you can ask the IRS to send you $8,000 and they'll send you $8,000 and then you reconcile it when you do your next quarter. Pretty cool, huh? All right. So this just shows you your 941 form that hopefully most of you are familiar with, unless you have an outsourced payroll program. At the very bottom, it says employee retention credit from worksheet number 1. There's a separate worksheet that kind of goes through that whole process. The other form, and again, I'm not going to go through these forms, but just to show you they're available. This is your advance payment of employee credits due to COVID-19. This is your form 7200. This is how you ask for money from the IRS that you think you're going to gain because of the credit. All right, so let me do some examples to show you how this program works. So we're going to deal with 2020 first. So we're going to look at quarter one, quarter two, quarter three, quarter four. So we're going to say in the first quarter, gross receipts for your business was $30,000 in the first quarter. In 19, in 2020, it was 28,000. So your 2020 versus 2019 was at 93%. Was it an eligible quarter? No, because you didn't get below 50%. So we go to quarter two, and your gross receipts were $40,000 in 19, but in 2020, there was only 18,000. So that was only 45%. So now you're in an eligible quarter, which means now you can count the eligible payroll for that period. Okay, we go to quarter three, and your gross receipts were 40,000. Gross receipts in 20 was 19, so you were at 47.5%. Actually, this quarter could have been 65 or 75%. It would still be an eligible quarter because you haven't reached the 80%. So again, that's an eligible quarter. All right, so this is where it really gets even cooler, is that in gross receipts in 2019 fourth quarter was 50,000. Gross receipts in 20 was 40,000. So you're now at 80%, which means you're now going to be kicked out of the program. Of course, it's the end of the year, and that's when the program's over, so it doesn't matter. But you're still eligible because you reached that 80% in that quarter. It would be the next quarter where you would not be eligible for it, but you would be eligible for it in that particular quarter. So now let's look at 2021. Well, it's only available for 2 quarters, so we're going to do a little bit different because remember, this is based on 80%. So gross receipts for 2019 is 30,000. Gross receipts for 2021 is 22.5. You had 75%. It's an eligible quarter. The following quarter was 80%. You reached 80%, which would kick you out of the program, but you're still eligible in the current quarter because that's the quarter you reached it in. So you're still eligible. If there was a third quarter that it came available for, you would no longer be eligible for it, but you are available for those 2 quarters. All right, so let's give you an example of actual monies. So we're going to start off with the 2021 first. So we have employee 1, we got employee 2, we got employee 3. I'm just going to leave out first quarter because first quarter is probably not going to apply to anybody. So again, this is in 2020. So we're going to take employee 1 in quarter 2. This employee made $15,000. So qualified wages in quarter 2 were $10,000 because you can claim up to $10,000 per employee. So which means you would get $5,000 credit towards that employee. So in quarter 3, he made $15,000. Unfortunately, he's already used up his $10,000. Therefore, there's no more qualified wages for that particular employee. Quarter 4, he also earned $15,000, but again, he's used up to $10,000, so there's nothing left. Employee 2, in quarter 2, he made $6,000, so he has qualified wages of $6,000. In quarter 3, he made $8,000. Well, he gets $10,000, so there's still $4,000 left of his credit. So if you add the 6 and 4, it gives you the $10,000 he's got. So now he's fully used up his. That's why in fourth quarter, he had wages except $6,000, but he still didn't have any qualified wages because he's used the $10,000 up. Number 3 is $3,000. He uses $3,000 in quarter 2. He has $3,000 in quarter 3. That's $3,000 qualified wages. In 4, he had $3,000 in quarter 3. So he used up $9,000 of the $10,000 of qualified wages that he had available. So he still had another $1,000 he could have used for that. Again, that's depending on the business being qualified for all 3 quarters. So then you come down here, so you would take the $19,000 of qualified wages, you would take the $7,000 in quarter three and the $3,000 quarter four, add that up, gives you $29,000. You get a 50% credit, which means you would have a payroll tax credit back to you for $14,500. All right, once we finish, we can go back and review these if you have questions. So now we're going to look at 2021. So for the credit for 2021, it runs a little different. So we're going to take the same employees, 1, 2, and 3. Wages paid in quarter one for this guy was $15,000. Qualified wages was $10,000. Okay. So in quarter two, he made $15,000. Well, you get to claim $10,000 per quarter, not for the entire program, but per quarter. So he has another $10,000 of eligible payroll in quarter two. The same thing for this employee had 7,000, 7,000, 3,000, 3,000. So basically, qualified wages in quarter one was 20,000. Qualified wages in quarter two was 20,000. So you add it up as 40,000. The credit is now 70%, not 50%. So you get a $28,000 tax credit for spending $40,000 in payroll. So if you qualify that, this is basically like winning the lottery. Okay, a lot of people are not familiar with this program. All right, so the only thing I want to make sure everybody's aware of is if you plan to claim an ERC for either for 2020 or 2021, you've got to do some careful planning to make sure you're not using PPP funds to pay for the exact same wages that are being claimed by the ERC. That's double dipping. So if you have PP funds that you're paying a certain amount of payroll for, and you've claimed $10,000 on this particular employee using PPP funds, you can't also claim it for the ERC. That's double dipping and definitely really illegal, and you would really get in trouble for doing that. So you just have to be very, very careful if you've got a PPP to make sure you're mathematically looking at exact dollars that are being used. And this is certainly the case where you would say, I want to make sure if I get a PPP, I'm only matching the 60% for payroll and doing my other stuff with the 40%. That way I still got that other 40% maybe I can use for the ERC credit. So that is the program. I am going to stop my recording.